What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update for you guys going into the next couple of weeks. So coming up next week, we're going to have a very substantial catalyst for AMC, which I want to briefly cover. And then we also have a new rule that the NSCC has put out. This is going to be 005. Now, we briefly covered this. We just touched upon it in one of my previous AMC videos, but I want to give you guys a more in-depth analysis now that it has been signed by the NSCC. And it is going to be going into effect in the near future. So this is going to be a very important update, and I'm going to explain all of the implications that this rule change is going to have on AMC in the simplest way that I can. So before we get into all of that information, if you guys would like to earn 2 free stocks with Webull valued up to $1,850, make sure you check out that link down below in my description. And if you enjoy the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps me out a whole lot in getting this information out to as many people as possible. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So when we look at AMC right here, we did see a very significant spike towards the beginning of this week, and then we did see a significant sell-off. So we did close the week at 10.03. It is a very good sign, not only psychologically, but for the price in general, because options are expiring in the money, that AMC closed in the double-digit range for the second week in a row. Now, if you guys have been watching my previous AMC videos, in my opinion, I think a significant gamma squeeze is going to kind of light the fuse. If you guys remember my analogy and my metaphor that I used to use, you got to think of a stick of dynamite with a long wick coming out of it, and the retail investors, the apes, are sitting there and just clicking a lighter right next to the fuse. The lighter is sparking, but it hasn't lit yet. Now, I do think that a significant gamma squeeze is one of the possible catalysts that could light that lighter and light the fuse on that stick of dynamite, which is the AMC short squeeze. So when we come over to the option chain, I just want to show you guys something. So we did see all 12,000 of these contracts expire in the money for this $10 strike, but we did see AMC go into the $12 range at some point throughout last week. So if AMC were to have closed above $12, we would have seen all of these contracts expire in the money. And if you guys understand a gamma squeeze, essentially what has to happen is that when the institutions are selling you naked calls and you are buying them from them, so you are just buying calls if you think the stock is going to go up, when the price starts to get really close, the price of the stock starts to get really close to these strike price, the institutions do something that is called delta hedging, and that essentially means they go out on the open market and buy enough shares to cover the contracts that they sold. So for every one contract that they sell, they need to buy 100 shares in order to cover their obligation on that contract. Now that creates somewhat of a positive feedback loop, because they'll have to buy more shares, creating more buying volume in the market, which will then push the share price of the stock higher, which could lead to all of these options expiring in the money too. So this is just one of my theories on how I think the AMC short squeeze could kick off. But now let's get into a very important catalyst that we have coming up for this company next week. So coming over here, AMC Entertainment Holdings, the largest theatrical exhibition company in the world, announced today that it will report its results for the first quarter ended March 31st, 2021, after the market closes on Thursday, May 6th. So we are going to see a lot of noise in the media about AMC's earnings. In my opinion, we're going to see a lot of hit piece articles come out from institutions and companies like MarketWatch and a couple of these other news sources that are essentially owned by the hedge funds. Now, I do not want that or the earnings to discourage any of you guys, because you have to think about what position we are in at the current time. Retail investors own a overwhelming majority of the AMC shares, and when we look at the failed to deliver numbers and all of the other evidence that we have that there has been some massive manipulation going on with AMC and it is extremely overshorted, we still have the winning hand. So I don't think that earnings is going to be the end all be all, but it is going to be a very important catalyst to get a little bit more of an insight into where the company is at the current time and where it is going in the future. Now, let's get into this proposed rule change. So the NSCC 2021-005 has been signed today. This was about 4 days ago. So implementation no later than 20 business days. So this is going to be very crucial. So let's take a look at exactly what this is going to mean. So that means May 24th is the latest day this could be passed if we are starting to count tomorrow on April 27th. So the DTC is basically covering themselves with this ruling, but the good news is that this means the squeeze is imminent. So this is going to be the 2-ape didn't read. This increases minimum fund deposit requirement for each member from $10,000 to $250,000 in cash. So let's confirm this. So when we come over here, this is going to be the actual SR NSCC 2021-005 PDF. So NSCC's review of the requirements of other clearing agencies and foreign CCPs indicated that NSCC's minimum required fund deposit requirement of $10,000 was significantly lower than minimum deposits or equivalent required by other such entities. While the minimum required fund deposits of such other entities is not dispositive as to the risk borne by NSCC or the proper fund deposit amounts to offset such risk, it is indicative of the amounts that users of other similarly situated entities can expect to pay as a minimum required fund deposit to use the services of the clearing agencies. So based on the backtesting results discussed above and the impact to members of raising the minimum required fund deposit to $250,000, the NSCC believes that raising it to $250,000 is the appropriate minimum required fund deposit amount that will maximize the financial impact to its members while maximizing risk management of activity that is guaranteed at the point of validation or comparison by NSCC. So we're going to go over that last part a little bit later in this video, but we do have something that I want to bring up as well. So there might be some confusion for you guys about this 005. So we do have a DTCC 005, which in my opinion is the most important proposed rule change that we are going to see. It has to do with the FTD reset clock, and I've made a couple of other videos on this as well, but the NSCC, as we come over here, is only a subsidiary of the DTCC. So NSCC 005 and the DTCC 005 are two completely different things. So now when we come over back to this Reddit post, we can see that there are 3,440 members. So let's confirm this really quick. So when we come over to this Excel sheet right here that you guys can download if you guys would like to off of the NSCC's website, right here we can see that 3,440, there are that amount of members. So I just want to make sure that we are confirming everything. So that would mean that $860 million would come in deposits. This is just from the members putting in more money, not counting all the assets short position hedgies have. So it even gets better. The NSCC is going to do tests that calculate the members' risk by analyzing their portfolio. Each member's required fund deposit would continue to be calculated with the same parameters and at the same confidence level for each member. Therefore, members that present similar risk, regardless of the type of member, would have similar impacts on the required fund deposit amounts. Now, this individual is saying that he thinks this means that the NSCC can increase the minimum fund if their portfolio resembles something of Billy Huang. So if you don't know exactly who that is, let's come right here. So Bill Huang was the actual founder of Archegos Capital Management, a fund that recently blew up. So the NSCC, in my opinion right now, is looking to kind of mitigate any kind of defaults that we are going to see in the future. And there are a lot of other ways that we can prove this as well. So when you really break this new rule change down, they are increasing the margin requirement. So when we come over here, we can actually see the actual margin debt that is out in the market right now. So this chart is actually inverted on this left side. It's a little bit hard to read, but as the chart goes down right here, you can see the numbers increase, and on the other side here, the numbers are increasing. So this is just to show a divergence. So the red line is going to be the margin debt, and the blue line is going to be the S&P 500. And as we can see, as the margin debt increases, the S&P 500 increases up to a certain point until it can't take it anymore, and then we see a sell-off. We saw this twice before, and we are seeing the margin debt at an all-time high at around $822 billion. So the margin debt out in the market right now is very significant. Now, when we come over here, this is going to be Joshua James' Twitter. We've pulled this up a couple of times, but shout out to this guy for putting out a lot of great information. If you guys are on Twitter, make sure you guys go give this guy a follow. But when we pull up this chart right here, the U.S. leveraged loan default rate seems to be increasing. So when you combine that with the amount of margin debt out in the market right now, this does not seem very good. So now let's think about this very logically. So we're seeing the U.S. leveraged loan default rate start to climb. We are seeing the margin debt out in the market really high right now. So what are these massive institutions doing to protect themselves? So first, we have JP Morgan and Bank of America doing some of the largest bond sales to raise $13 billion and $18 billion. For one, I think JP Morgan was $13 billion and Bank of America was $18 billion in order to protect themselves for any defaults in the future. And that is not all. So they are expecting some heavy defaults coming in the future. Now, when we come over here, we're going to be taking a look at some of these netting accounts. So we can see that JP Morgan right here opened 3 new netting accounts. And shout out to this person for just being punny for putting this out there. I've pulled up this Reddit post a couple of times, but it is still extremely relevant to the situation that we are in right now. Now, they actually added about 14 other of these netting accounts recently. So we can see that down here as well. I think it's a little bit lower. Right here, we can see that JP Morgan, these are the other 14. Now, this edit right here is what I want to take a look at as well. So I feel that there is some need for counter due diligence here. The netting account is addressed to the mortgage-backed securities department, the good folks responsible for the financial collapse, who, like other MBS, are good at chopping things up and bringing them elsewhere. I believe the blank here with netting accounts and the weekend meetings has to do with the commercial mortgage-backed securities having their books cooked. So that's a very bold statement right there with not a lot to back it up, but we actually have evidence that does back this up. So when we think about this, the different regulatory institutions really do not want another 2008 to happen again. That is not something that they want, especially coming off the pandemic with all of the different financial constraints that it has put on our system and all of the different quantitative easing metrics and methods that the Fed has used. We really would not be able to withstand such a collapse right now. But what the DTC is actually doing right now, this is kind of how it all connects together. They've actually been doing this stress test over the past week. So it's addressed to the netting members, which we just saw JP Morgan actually jump up their netting account amount by about 17, which really suggests that they are expecting defaults to come in the future. So we can see that this is going to be addressed to the government securities division and the mortgage-backed securities division. So they know that this is going on, and they are doing a stress test to just see how bad this situation is. So we all know that this stress test took place over the past week, and I'm eagerly waiting to actually hear these results. I don't think that they are out yet, but if you guys actually have any more information about this, make sure you drop it down below in the comments because I definitely want to see what has happened here. So we had a lot to cover in this video, and I just want to give you guys a brief summary of what happened. So the NSCC wants its members to basically put more margin into their accounts. Now, the reason for this is that we are seeing the margin debt massively increase and the U.S. leveraged loan default rate start to climb as well. Now, because of this, JP Morgan and a couple of these other institutions are creating new netting accounts because they are expecting more defaults. And in order to withstand any significant amount of faults, they raised a ton of capital in the form of bond sales. Now, these netting accounts were also addressed to the mortgage-backed securities department. We are also seeing the DTC come in and do a stress test to their netting members. So this is all tying together. And here's how it could affect AMC. So when we see any kind of default of any institution or a hedge fund, their other positions have to be liquidated in order to cover this. If one of these institutions has been naked short selling AMC, their position is going to have to be closed, and that could be the first domino that gets set off in this short squeeze. So I know we went over a lot in this video, and some of it was pretty complicated and complex. So if I did not explain this simply enough for you guys, because I know that some of this is pretty difficult, make sure you leave me a comment down below, and I will do my best to answer all of your questions. So that is going to conclude this update for AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great weekend, and I'll see you guys in the next video.